Topic 17A, Foreign Funds. In this topic, we'll talk about how to use foreign funds to get exposure of your portfolio to the international market. In the last topic, we talked about holding individual stocks. When you choose to invest in mutual funds or index funds, there's immediate advantage to holding individual securities. Namely, you get professional management versus selecting your own stocks. You get some manager to specialize their time and do the homework to find the specific stocks or bonds or portfolios. You also get immediate diversification. For a $100 investment, you could buy one share of Sony or Toyota or BMW, but you can also, for $100, get a diversified portfolio across a country, a region, or across the world. You also get reporting. On a quarterly basis, your fund manager will send you reports, and at the end of the year, you'll get tax statements to help you complete your income taxes. When you choose to invest in foreign funds, you have a basic choice, and that is whether you're going to index, getting funds that match an index, or get a managed or mutual fund, funds that try to, say, beat an index and are actively managed. So let's think about an index fund for a minute. The most widely used index is the S&P 500. So the Standard & Poor's publishes a list of the 500 largest stocks in the U.S. and it reports on its value every day. So you hear things like the S&P 500 is up 1% today. Since it's so widely used, an industry has arisen to create portfolios that match these indexes, like the S&P 500 or the Dow Jones Industrial Average or the Wilshire 5000. So for an index fund, it's simply a fund that tries to match a published index, like the S&P 500, or in Japan, the Nikkei, or in London, the Financial Times, or in Japan, or in the US, the NASDAQ for tech stocks. The advantage of matching an index is there's going to be low fees because there's no active management, so you don't have to pay high-priced financial managers to try to select stocks. You simply match an index. Now, if you want an international fund, you can get a fund that matches, say, the Nikkei or S&P 500 or another index in any other place in the world, or you can get a country fund. A country fund might just capture, say, the largest stocks in Japan or China or Great Britain. There's also regional funds, so you can get a Europe fund or a North American fund or an African fund or an Asian fund. There's also funds that group according to economic development. So an EAFE fund is a fund that captures developed economies. An emerging market fund is a fund that captures developing markets like China and Russia. And then you have frontier funds that capture even smaller markets like Vietnam. There's also world equity benchmarks. These are funds which capture the entire investing universe. So there'll be funds that include both US and European and Asian and African stocks. And there's also bond funds. So again, an index fund is a fund that simply matches an index published by another party. There's also managed funds. Managed funds are funds which try to beat one of these indexes. So you might have a large cap US mutual fund that charges more fees than an S&P 500 fund, but their goal is to try to beat that index. So all these areas will have funds, or all these indexes will have mutual funds that try to beat the index that also trade at higher fees. ETFs are investments that look like stocks or traded like stocks, but they're actually index funds. So all of these index funds here will also have ETFs. So for example, S&P 500 is an index fund that you can get through many brokers, but you can also trade SPY, which is a stock symbol that trades on a stock exchange, and that's a stocks or a vehicle that trades like a stock, but it really is an index fund. Many people find that trading these are much easier because you can buy them and sell them intraday. You could buy them on margin. You can buy options on them. You can short them, which the advantages over just holding an index fund. These are some of the top ETFs a few years ago. So you can see the SPY is the S&P 500 index fund. It's also called a SPDR. and it had 72 billion in assets. And you can see that for 9 basis points, that would be the annual expense ratio for holding this fund. And you can see some other large funds. Here's a gold ETF, GLD, a spider. And you can also see an emerging market fund. And you can see EAFE fund, which is Europe, Australia, or Asia, Far East. And this is a fund that really captures developed markets. This is a fund that captures developing markets. So let's talk about the EAFE fund. So EAFE is an index that's published by Morgan Stanley. And what it does, it tracks developed markets around the world. Now here's a list of developed markets. So you can see the US, Japan, UK, France, Germany, Canada, Switzerland, Italy, and so on. That's the largest economies, developed economies in the world. The EAFE funds capture the largest country or largest developed countries in the world, but they exclude the US, Canada, Korea, and a couple others. So if you want to invest in developed countries all over the world, you could just buy an EAFE fund. And these are also go by a nickname EAFE funds. So instead of saying EAFE, you can just say I'm buying an EAFE fund. If you want to get an emerging market fund, so these are funds that track the BRIC countries, which would be Brazil, Russia, India, China, and other developing countries like Taiwan, South Africa, Mexico, Malaysia, and so on. So I can buy an emerging market fund that would track, say, all of these economies. And when we buy emerging market funds, we also use a nickname EMA. Instead of saying emerging market, you can say I bought an EMA fund. In addition to get index funds, you can also get a managed fund. A managed fund is a fund in which is actively managed, so a portfolio manager is hired at great expense to try to beat one of those indexes. And the fees on these index funds often exceed 100 basis points and sometimes up to 200 basis points. And there's also a sales commission often associated with buying active funds or actively managed funds, or sometimes called mutual funds. Here are some of the top international mutual funds in 2010. So you can see the Virtus Emerging Markets Opportunity Fund. It says Diversified Emerging Market. It had 5 stars by Morningstar and had a 21% return as of that point in that year. But you can see the expense ratios of some of these firms: 172 basis points, 150 basis points, 178 basis points, and so on. So the hope in buying, say, the emerging market fund from this company is that it'll beat an EMA fund. Now, EMA fund, we can go back and see that ETF on EMA. This EMA fund has an expense ratio of 72 basis points, and it'll track the Morgan Stanley EMA index. This emerging market fund has a 172 basis point fee, but your hope is that it'll outperform the market. So the goal with managed funds is you're trying to pick a fund which will beat an index. However, the evidence is not too good that it's going to do that. Also, when you buy a mutual fund, you have to be careful that what your commissions are. We don't call them sales commissions in mutual funds. We call them sales loads. And each mutual fund will have a different type of sales commission. And it's called Class A, Class B, or Class C shares. So a Class A share of a mutual fund will have a front-end load or sales commission. For example, it might have a 5% front-end load, meaning if you deposit $100 at that fund, only $95 is invested. $5 is kept as a commission. They'll also have ones that have back-end loads. So there may not be a front-end load, but there'll be a deduction of commission when you sell it. Or you can have a Class C where they have no loads, front-end or back-end, but they'll deduct annual fees every year. So, for example, they may take off 1% off the asset value every year. When we look at the performance of mutual funds, it's not too good. Here's just one study I had showed that from 20 out of 28 years, U.S. equity fund managers failed to beat a Wilshire 5000 index, which is a broad index for the stock market. Another study I recently looked at showed that if you find a fund that, say, say, beats the market, it's a 3 or 4 or 5-star fund, you say, well, I'll just stick with that fund. Maybe they'll beat the market again. Well, the evidence isn't very good. The evidence is that if a fund manager finishes in the top half of portfolio managers in 1 year, they have just equal chance of being in the top half the next year. So there's no real advantage to knowing if a fund beat the market. However, there is some evidence that one aspect is low fees. If a fund tends to have lower fees, it will tend to outperform their peers. So that's our choices when doing international diversification using funds. You can use international index funds and ETFs, which are security investments that track in index funds and trade like stocks. And there's also managed funds. Here's just a little data I collected a few years ago. So I looked at the S&P 500 from 2003 to 2010, and I found it had about a 4% return and a 15% standard deviation. And if I take the Sharpe ratio, which would be the return on, say, the S&P 500 minus the average risk-free rate of that period, divided by the standard deviation, kind of a return over risk measure, I can see that ratio is 0.24. I then constructed a portfolio that was 50% U.S. market, 40% EAFE, and 10% EMA. When I did that global portfolio of 50, 40, 10 U.S. EAFE, EMA had a 7% return and almost 18% volatility. So it had a better return per risk ratio. So that shows you right there, you can improve your performance as far as risk-adjusted returns by going to a global portfolio from domestic. However, there is a caveat. The best times investing globally may have passed us. About a decade ago, correlations between U.S., EAFE, and EMA markets were around the 0.6, 0.7, 0.8 range. Recently, however, they've been tending more to 0.9, so that diversification benefit, those higher Sharpe ratios are eroding over time, but it's still beneficial to hold a diversified global portfolio. So hopefully you get an idea of how to invest in global equity markets by investing in either index funds or managed mutual funds.